Yeah, April's the founder and president of the Rudin Group. She is acclaimed financial services marketing strategist and digital media expert for the wealth management industry. April writes for the Huffington Post, wealthmanagement.com, Investment News, and Fundfire. She has partnered with many of the most revered financial institutions in the world to design and execute forward-looking marketing programs. April has her Bachelor's of Science in Business from Wayne State University in Detroit, and she is on the PAM Advisory Board, and also April recently became the first woman elected to the Hedge Fund Association Board. So congratulations on joining that board.
Thank you, I appreciate it. So actually, I know it's 2014, but the first woman ever elected to the board of directors for the Hedge Fund Association. So that is kind of exciting, and I guess that sort of leads us into a discussion about what things are changing in the world of hedge funds and marketing.
Let me actually start with that, because with the Hedge Fund Association, for people who are not aware of what it is, can you give like the quick elevator pitch about it?
Absolutely. So the Hedge Fund Association is a trade association, and we provide education and training and lots of different programming for our members. So I started with the HFA, with the Hedge Fund Association, by chairing the High Net Worth Board. And the High Net Worth Board's mission is, among other things, to bring really educational programs, information to our membership around dealing and understanding with the high net worth mind and what their behaviors are, what their buying signals might be, and how to basically work with them. So.
Okay, that's cool. And I know they do events around the country. So I know they do some here in Chicago.
Yeah, they're actually global, so we do events all around the world. It's thehfa.org in case anyone wants to check it out. But it's a wonderful membership organization, I must say.
Cool. So I know you're based in New Jersey. Did you grow up there? Did you move there? Did you just take a long trip on the Pennsylvania Turnpike and ended up in New Jersey?
I don't know. So I actually was born in Chicago, raised in Detroit, and began my working career in Detroit with Kelly Services, the temporary help company, and I ended up relocating to New York, and I've lived here for more than 20 years, but I definitely consider myself a Detroiter.
Okay. Detroit is, it's been in the news lately.
Yes, it has.
So let me ask you this, because you have your degree in business from school, and did you know that you wanted to go into marketing when you were in college, or was it some later point in your career that you had that aha moment, and how also did you decide it would be financial services?
Well, that's a really good question, Mark. So, only a few people really start off in college, I think, and really know what they want to do. But I was always interested in technology, and I started just about straight out of school working for Kelly Services, as I mentioned. And it was a very transformational time. It reminds me of now, when word processing was starting to come into the market, PCs were coming into the market, and Kelly's offices and Kelly's business was based on typing tests and words per minute. So that was sort of the intersection of training, technology, something that always fascinated me. And so fast forward 20 years ago, I ended up creating technology, training programs, marketing programs for Kelly Services, and then moving to New York to act as media spokesperson. So, and I'm a latecomer, I always say, to financial services. I'm only 10 years in financial services, but I founded my firm based on the notion that most financial services professionals, wealth managers, hedge fund managers, investment bankers, maybe to a lesser extent, but they're really quantitative people. They're really left brain oriented and straight thinkers, and most creative people are marketers. They have the right brain. So I founded the Rudin Group to help the left brain guys try to do some right brain marketing.
Actually, that brings up a really good point, because while the time I've been in the industry, the one thing I found over and over again is that you have people who are very smart, who very good with math. You got traders and programmers and portfolio managers, but they don't necessarily understand what it takes to build a business. And they, it's kind of like the concept of I build it, they will come. That's the mindset, which definitely is not the way to do it. I mean, I find even with myself that when I talk to managers, and I tend to talk more to emerging managers,
right?
And they are, they just, they have that mindset of I build it, they will come, and I have to explain to them, no, you, like any other business, you have to go out there, you got to do the legwork, get a name for yourself, build the branding, and all of those fun things.
Well, the truth is that that's what the whole story is really about, and that's why I'm glad that you invited me here today. I get the very same thing from emerging managers and even established managers. They'll throw their pitch book in front of me and think that that tells a story. They lead with their track record and think that's all that they need to talk about. And the truth of the matter is that there's so much more today that especially emerging managers can talk about. So with the passage and the enactment of the Jobs Act, they're able to do generalized solicitation. So there's a wide variety of different platforms and channels that you can use to get yourself known. You can create white papers, you can use social media, you can be PR, media relations, and it's a combination of all of those things along with personal branding. So for emerging managers, why did they choose their particular strategy? What strengths of themselves does it play on? Combination of chief investment guy plus operations guy. What is it that brought them together? So it's this sort of storytelling that really resonates with investors now, and that's a really big opportunity for hedge fund and other alt managers to really come out with their story. I feel like for emerging managers, it also flattens the playing field. So if you have a very simple strategy or impact investing or something that is affinity sort of investing that is easily communicated to the public, I think you definitely have a better chance of having your message resonate with investors and wealth managers, as opposed to, say, a fund of funds that may look like some kind of black pool that's difficult to understand. And one last thing, and I don't know why I have to remind hedge fund managers of this, but we know that past returns don't equal future results. So leading with the track record is not really highly recommended.
So and that's usually what they do, and like what you just said, I mean, they spend most of their time talking about the strategy. If they're a more established manager, obviously they have more of a track record they can talk about. They have a bigger company they can talk about. But for emerging manager, in a way, they're forced to really, if they want to make an impression on someone, they have to talk more about the story opposed to the track record, because there isn't as much of the track record there. So when you're meeting with a manager, are there some items or like, if you'd like, I want to say checklist, some things they should be doing to think about at the beginning of, like, when they're setting up meetings or going into a meeting?
I would say number one, you could back up even farther, Mark, and that is when people are starting their fund, I don't think that they allocate or create any budget for marketing. And that's probably the surest way to fail, is to create no budget for marketing and view it as a DIY or do it yourself. So just as I wouldn't do my own investment strategy or set up my own hedge fund, I don't know why hedge fund managers, seem to think that they can just do it yourself marketing and figure out what they should do. I've seen so many pitch books that, are a big yawn, go to sleep, pages and pages of charts, and, they're always thinking big, and I'm thinking small, right? The easier and the smaller way to tell your story is one that gets heard. The longer, more boring story, which is, to your point, that's what the quant might tell, right? I was born, instead of, starting with this happened last year, right?
Yeah. And you're bringing up a good point too, because I know with my experience, and I talked to other people in the industry, it's the same thing, that the managers don't allocate a budget for marketing or for business development. It's more or less, hey, we'll email some people, we'll go out and talk to a few people, and that should do it. And they don't realize that, they're shooting themselves in the foot, and they look at it as a cost instead of as an investment to grow their business.
Yeah, that's a good point. And just to back up to another point also, you mentioned about mass mailing. So they're obviously looking for accredited investors to invest in their fund. But the truth is that an accredited investor isn't a one-size-fits-all person, right? So accredited investor might be a retiree, it might be a business owner, it might be a widow, it might be a young technology executive. Maybe you want to have a campaign that reaches out to centers of influence or create a referral network. So each one of those audiences would require some different kind of messaging and different kind of email or marketing campaign. And I find that most managers just do some kind of blast to everyone that's expected to really create momentum. And so nothing usually happens, needless to say.
So if they start parsing up as to how their different audiences, and so is there any kind of methodology? Is there a science to the madness of how they start looking at the different audiences and how they do that research as to what kind of message will work best?
Well, first of all, they can't do the research, and they shouldn't do it themselves. Let's get that point clear. They need to hire a professional for this heavy lifting, and that's where they go wrong. But the truth is that someone who has a background in marketing will help them create a roadmap to get to the target clients that will help them convert much quicker. So if we just use the example we were talking about before about impact investing, let's say it's some rainforest in Costa Rica, right? Something. So if you take that example and you think about who might want to invest, right, in a strategy that supports both rainforests, Central America, you start to think about those things that might align with people. And so figuring out who your target market is becomes much easier once you think about that. If you're an internet fund, maybe you're going to target technology entrepreneurs, because they're going to be more interested in investing in your fund. Biotech, perhaps you concentrate on doctors or healthcare professionals that might be interested in investing in something more technology oriented. It's certainly not limited to that, but for small emerging managers, it's a good place to start.
Okay, that makes sense. And so when let's kind of turn the table a little bit and look at it from the perspective of the manager's always going out. They're saying, hey, we can do a good job, and obviously, yeah, past performance is no guarantee of future results. But when things do go bad, when they are in a drawdown, I've seen it where that's where the managers become nervous, and they are less likely to want to talk to the clients. What do you suggest for people during those periods?
So the best practices are really to have the same kind of communication and the same kind of marketing plan, whether the market's up, your strategy's up, or your strategy's down. So people also, I see a lot of managers send out some kind of monthly reporting, right? And that again is a big snoozer, right? So they want to, if the only thing on there is their performance and it's good or it's bad, we don't want to zero in on it, right? Because you're looking for long-term investors that are investing long-term and keeping their money with you. So it's cultivating that community. So again, to go back, I find the planners have no plan, which is they may have an investment strategy, but they don't have a marketing plan, they don't have a communications plan, to what you were talking about, and they don't have any kind of strategy around that. So again, what I would say is that within your newsletter, when you're sending out your monthly performance, your quarterly reporting, to really make it something more broad-based. Talk a little bit more about other funds or what's happening within that market or particular markets. Have someone from the fund perhaps write something personal as a note about it. I find, I get asked a lot, like, what should you do when the market's down or your performance is bad, and how should you handle that? And if you have regular monthly communications, whether the market's up or whether the market's down, you're actually controlling your message. You don't want to reach out when the market's up or when your fund is up and say, wow, look at us now,
Yeah.
because it's just as likely may happen, don't look at us now, right? Hiding under the desk. So having the same sort of communication strategy, I think, is important. Another thing that's important today is for managers to have some kind of transparency, I think, and authenticity. And so, I'll advise my clients when they're creating communications, I'll help them write something that, really takes ownership over their fund. They're just as disappointed with their performance as their investors, right? And I think that's a really, really important tact for managers to take in communicating.
With that too, what I found, because I used to be involved with a fund, and when times are good, it's great. It's easy to get that message across, and people are, they're hearing that you have positive returns. But yeah, and then when it's in negative periods, it's a much more harder message. But yeah, I think if you can keep a constant message, regardless if how your performance is either up or down, and continuously trying to explain what it is you do and understand, or have the clients understand what you do, so it helps them, I think, manage the expectations. So regardless of what type of period you're in.
Yes.
Yeah, and so it's I think, coming back to your point about just keeping a very constant message is helpful. And yeah, managers do feel bad when they're losing money. It's and it hurts them as well as the investors, and it's just a matter of, okay, this is part of it. But if they also explained that we do go into drawdowns, that we have these moments where things don't work as well, so the investors understand that, I think that also helps.
I do too, because it's really a relationship that you're looking at, and it's a long-term relationship between managers and their investors. And you want people to obviously refer other friends and other qualified investors to your fund. So I think it goes beyond the actual performance. I mean, I know that for a fact in the wealth management community that many times people are willing to accept lower returns for the relationship that they feel that they have with their wealth manager. And I think the same thing is true for especially an emerging hedge fund. That's what I'm suggesting. For a biotech fund, maybe you should really go after the physician community or other scientists or people that might have an affinity or a real good scientific understanding of your investment, and understand the cycle, let's say, of product development. And so be willing to stick with you longer than your average Joe or a retiree or someone that's looking at some kind of life event. So I think matching up your fund with the right sort of investors is also key for building your business and raising the capital that sticks.
That would make sense, because yeah, there are some investors that may not fit your fund, and so you want to find ones that it does fit, and that it's more of a long-term. It's a marathon. It's not a sprint, as I think you've said it to me a few times.
Yeah, and that goes back to the pitch book. So people will show me their pitch book, and I don't even know what to say most times. It reads like a horror story or a nighttime bed story, and it's really long and complicated, and people can't understand it. And so I think also that's another really crucial thing to get professional advice on. What should be included in your pitch book? What does your website look like? Today, funds are able to have websites. So people are going to be vetting you. They're going to be Googling you. It's important from an online reputation standpoint for fund managers to make sure that they Google themselves. They see what might be on the internet about themselves. They see what might be there about their partners, their fund. Another part of best practices would be to have a really robust LinkedIn profile, let's say, because when someone vets you, LinkedIn is going to come up and they're going to look at your background and your experience. So you want to have it be as robust and full and storified as possible. How did you, in the same way as you asked me a question, how did my career evolve? You want to be able to have your LinkedIn tell that story for you as a manager. How did you get into this field? Why did you choose this strategy? Why do you feel strongly about it? How did you build your investment team? And so on.
Well, it's funny because you talk about with, looking online, the course that I teach at DePaul on managed futures, I have the students spend a fair amount of time on due diligence of managers. And since they're not actually meeting with the managers, it's literally whatever they can find online. And sometimes they get very creative and being able to find some interesting things. In some cases, they find that the managers in past businesses had violations, had regulatory violations, and they would say, I don't care how good the strategy is. There's enough of a red flag out there that we're going to stay away. And I think that's too where the marketing and the due diligence start to come together. They intersect.
Well, I think people have to really remember that the internet is forever, and the internet remembers everything. So, to your point, even though you have maybe offline activities like a pitch book, or you think that you're making appointments and selling in a hand-to-hand combat, understand, the mentality of your students and, most others, I would venture to say today, which is they're going to get a referral, and instead of just acting on it as they may have in the past, they're going to vet it. And the first place they're going to vet it is called google.com. So, I like to say, grab a glass of wine and Google yourself. Take a look and see what's out there. If you know what's out there, you need to create new content, perhaps blogging, PR, other things to push, negative or even neutral stories about you that you might not want your investors to see down. So Google search is really important. And Google images, let me just bring that one up too. People don't search images, and there could be some images that others have posted of you that you may not want.
Perhaps in Facebook?
Perhaps in Facebook, all over the place. You'd be surprised. Yeah. Unless you Google yourself, you don't know. So I have one client who, was really nervous about going on LinkedIn because she didn't want her story told, and she was very concerned about her privacy. And during one session, we just happened to Google her, and we saw that her family photographer had posted her family pictures. And she had no idea because she'd never Googled herself.
So it's for everyone to see.
Mild compared to LinkedIn, right? There was her daughter, her daughter's photo. I asked her, does your daughter have a pink dress? She said, of course she does. She's 9 years old. And I described the collar, and then I just flipped my computer around, and she was shocked to see that, the photographer had tagged her pictures with her name.
That's a really good point. So let me ask you this, because with education becoming a bigger component, I see, whether it's the brokerage firms, it's the managers, the advisors, or even on the consulting side, and they're all realizing that education is a growing component to business development. And it's also part of their marketing, it's part of their branding. They can, if they're doing, good research or putting out white papers, they can be thought of as a thought leader and things like that. Is there, when you're talking to clients, is there anything in particular you tell them to do along those lines?
So again, it depends on the strategy. So let's go, let's use a couple examples, say the impact investing. When you have that kind of strategy, you have to think about where your target market is. So perhaps they're on Facebook, perhaps they're, located on Twitter. Those two platforms might be the places where they're getting information. If you're a biotech fund, perhaps you want to think about getting some press or being involved with the American Medical Association. So depending on where your target audience is, it's going to be a mix of all of those activities. But I can't emphasize enough, it's being able to tell a simple story, right, and not leading with track record. Every time you lead with track record, just feel like you're going to be setting yourself up for failure also, right? Because again, future results are, don't guarantee. So I see that mistake all the time. So I guess for me, best practices in a pitch book would be, just real simple storytelling. That can even come in one infographic. So it's not the number of pages. Shouldn't be concerned about that. But it's telling your story in a simple, easy way that people can understand your investment strategy. And I think that will be what attracts investors. But those strategies, convertible arbitrage or things that are more esoteric, become more difficult to sell and will continue to be for the reason you pointed out with your students, right? They don't understand it, they're not going to want to invest in it.
Right. But that's I think the other aspect of the education that's coming into it. People put out either short articles, they put out white papers, webinars. So
all that stuff is good, Mark. But let me say this: here's the mistake. So what's the downside of it?
Yeah, please. What's
the downside of that is no plan. Again, so a webinar is good, an article is good, but not as a one-trick pony, right? You can't have one article and think that that's really set the stage. So again, you have to have a series of webinars, let's say, a series of client events, outreach in terms of, a white paper is good, but it's probably long. So maybe you take your white paper and you break it into blogs and use that as part of your communication strategy in a newsletter. The other thing I think that's really important for managers to understand is not every investor is on every platform or looking all the time. So you have to put consistent messaging out, whether it be LinkedIn, Twitter, blogging, newsletter, PR. You want to come up with some your pitch book. You want to come up with standard messaging and then repeat that same messaging on a variety of platforms all of the time. Because it's opportunistic. We don't know who's going to be looking, where, when, and be looking for our strategy.
Yeah, and as someone who writes a lot, as I do, I can definitely tell you from firsthand experience, writing just one or two articles doesn't cut it. It takes a lot, and in and of itself, it also starts to become a bit of an art form. But you realize that is part of your marketing. That's part of getting your message out, part of your branding, part of your education, and it all just kind of fits together into a package. And
right. I was just going to say, I think if people look at a 12-month calendar and think about the business cycle and the just the yearly cycle, tax time, summer, then it becomes logical. And writing out even the titles, creating like an editorial calendar, and then perhaps even inviting other people to comment on your blog, right, can reduce the amount of writing and also increase the circulation. Anyone else contributing to your blog is more likely to pass that along as well.
Oh, definitely, because then their name too is being linked to it. So when people are looking for their name, like if it's on Google, your site or your article could also pop up as well.
Exactly. Just the way we're linking together now. Now we're forever linked.
Exactly. Whether we like it or not. Let me ask you this, because another aspect to it, I think, is you don't want to start out with the track record, but somewhere in the conversation you are talking about the strategy and the returns and all of that. How much do you tell clients to focus on managing the risk of their strategy? Should they stay away from talking about that much, or should they emphasize it quite a bit?
I think that the entire communications and marketing of financial services products has changed so much. And looking forward with passing of the Jobs Act, we can expect that to continue. And then also just the whole, authentic and transparent demands and behaviors of next geners. So, Bernie Madoff was able to survive just by referrals, right?
Yeah.
And he used another very, very powerful marketing strategy called scarcity. And scarcity really, worked its wonders for him. So people were knocking down the doors to get into his fund, right? And he didn't even have to go look for them. So that's what every manager wants, is inbound leads, but of course they should have an actual fund behind it. I do recommend that.
It usually helps.
Yeah. But putting that part aside, understanding and explaining what your strategy is and what the risk is, what the upside, what the downside is, I think that's what will create the relationship that especially emerging managers want with their early on investors, and that's what will lead those investors to also get their circles and their social circles involved, and perhaps invest also. And so, there's nothing more authentic than being honest, right? Or teaching, as you said. Accredited investors are not one person, as I said. So, accredited investors can range from hedge fund managers themselves to, a grandma that lives down the street. So you can't have the same pitch book. You can't have the same pitch materials. You can't describe risk in the same way. You can't explain reward in the same way to each of those audiences. So that's why I go back to the most important thing is figuring out who is your audience.
And that's actually an interesting point because was it back in December I had a guest on who works with family offices. And she said, if you've seen one family office, you've seen one family office. That each one is very distinct, and how you build the relationship with them and how you communicate with them can be very different from one to the next. And I think you're pretty much saying the same thing with investors in general.
Well, it's true with family offices too. That's an often used quote. So, single family offices have their own sort of flavor and their own sort of idea, but all of that's really changing. And then multifamily offices, because they're serving a wide variety of clients with different investment needs, may not have the time actually to go out and do the due diligence that you talked about before, or to even scout out new managers. So I think it's important for especially emerging managers to find forums and find ways to connect with multifamily offices. But the idea, of once you've seen one single family office, you've seen one single family office means that also, 98% of wealth inheritors are changing advisors. And that means wealth managers, that means allocation of assets, that means, alternative assets. It means advisors including CPAs, attorneys, everyone. The next gen doesn't want to deal with their father's advisors or investment team. And as I mentioned before, they're willing to sacrifice a few points for doing good while doing well. So these, certain kinds of strategies appeal to next gen more than anything, more than something that might be a hot, fun simply because everybody's talking about it. Actually, the opposite is true. They would be more likely on the behavior side to invest in even a smaller fund because it's maybe something that they really believe in.
And that they might have a stronger connection to as well and understand better?
Exactly. Okay. So they're less impressed with suits, if you want to think about it that way.
Okay.
Whereas the Bernie Madoff client, the baby boomers, were more impressed with suits, more impressed with track record, more impressed with the cachet of saying that they're invested in a particular fund or something. I think that's what led to that, and I don't see that happening again.
Yeah, and in his case, it was that no one was asking any questions for the most part. I mean, it was like, oh, my friend's investing, I should invest too. And so, yeah, he didn't really have to do a lot of marketing. I mean, I guess initially did, but it got to a certain point where there's enough momentum in there that people were just jumping in.
Well, I think he was a brilliant networker, right? So
Yes.
if you think about it that way, he used platforms, like you could say LinkedIn, he used his golf club in Palm Beach, right? So he would set up shop there and camp and network, right? And, create a buzz, all of those traditional things that we would think of as marketing activities, except he ran it offline and he ran it brilliantly, right? He had pent-up demand for his fund.
This is
Which,
true. It's what every investor wants, but yeah, like you said, they need to actually have a real fund.
right. Yeah, that's part of it.
Let me ask you, because you've talked about a few different points tonight. If you were to like package it together and say, hey, here's a handful of ideas that a manager or an advisor should be thinking about when they're thinking about marketing and branding their services, what would that list look like?
Number one, create a budget and hire a professional. Just as I wouldn't manage my own portfolio, marketing is not do-it-yourself. You're going to yield, if there's any kind of allocation that you make in your budget that will yield return, it's going to be marketing. Forget about what your office looks like. Forget about taking people to lunch. Forget about some of the things that people get concerned about. The quality of paper, I don't even know what I've seen people do. But spend money in identifying who your target audience is and having some kind of professional and ongoing program created. Again, the planner should have a plan. It just goes back to the way they manage their investments too. You wouldn't start, every hedge fund has a strategy. It's not, every day is an ad hoc decision over what I'm going to do now. Let's buy this, let's buy that today. A random pick from a hat, right? So, but I find that that's the way they approach marketing. Oh yeah, I forgot to call him, and his sister's brother might be somebody because he has a lot of money. But that's just a complete waste of your time unless you know exactly who your target audience is and what you're going to say to them.
And then if you looked at it from the other side, I'm sure you probably have a very long list of examples of people just doing a lot of damage to themselves. And what, would you say that there's like a few things that, same thing, someone should be keeping in mind? I mean, in a way, you've already kind of said it, but a few ideas someone should be keeping in mind that could really damage them.
So I think number one, is really that communication. So we spoke a little bit, Mark, about, who is a fund manager? He's a quant for the most part, right?
Right.
And so listening and understanding what questions potential investors and your existing investors might be asking is going to be really important instead of answering them in sort of a perfunctory way, right? So you could have more damage, right, by not listening to the actual question, but just giving a stock answer on something. You could do more damage by not answering instead of answering, right? It's better to be authentic, and it's better to be honest and, answer an investor straight up than it is to figure out a way around it, right? Like Bernie Madoff, hide in the closet, right? Eventually they're going to find you. So, eventually your stock could have been, or your fund could have been up for years and years, but you're going to go down, right? Yeah. So it's the idea of keeping that constant, communication with your clients and your investors.
And I mean, with that too, I think, saying being authentic, and I completely agree. That's so incredibly important for the relationship. But that also means that at times when they ask you a question, if you don't have an answer to it, I usually say the best thing is just say, I don't know, but I can get back to you.
That's you know what? I'm so glad that you brought that up, because that's huge. And it's huge for hedge fund managers to be able to say that they don't know something. Right? And yes. I'm sorry, but these guys are my clients, right? I think that by saying, I don't know that, but I do know this, or I don't know that, and I'll find out for you. And then following up. Those are the things that really create the client, the investor, and fund stickiness, right? It's taking care of the problem, right?
Right. I mean, you're saying, hey, I'll get you the answer. You want to know it? Okay, I don't know it right now, but I'll get you. I mean, it's the same thing too with me teaching with my students. So, I don't know everything. I tell them that at the beginning of the quarter. But if they ask me something and I can't answer it on the spot, it's the same thing. Let me find out. I'll get back to you, and I'll get you the answer. Because you're asking, and this is about education, so I want you to know.
Yeah, the same thing. I mean, that's the promise. You've made a promise to your students to give them information, and a manager has made a promise to give that same information to their investors. So, a matter of keeping the promise.
Okay. Let me ask you. You have a couple of articles. One of them, I think, was like Mad Men of Wall Street or something like that.
Mad Men Meet Wall Street. Yeah, I read that.
Yeah, and I think there was another one that was something similar. And were those articles about the Jobs Act? Is that what it was trying to remember?
Yeah,
exactly?
So Mad Men Meet Wall Street was a piece I wrote after the Jobs Act was passed, but before the SEC had enacted it. And it was just, a little bit of a play on words, of course, in the title. But again, something hedge fund managers can learn is having an engaging title instead of, the Jobs Act and hedge fund managers, right? Nobody wants to click on that. Mad Men Meet Wall Street, we had a lot of clicks. So basically, when I thought about it, I thought, here are these type A guys of Madison Avenue, right? And Mad Men meeting type A guys, hedge fund managers, and how ugly might that look, right? Faces on billboards, the Super Bowl, everything potentially. You could have Miller Lite and, X hedge fund, right? Advertising right next to each other.
Yeah.
And of course, that was sort of a bomb. Because not too much has happened in that arena, and I think the reason for that is that again, I don't think that even those established hedge funds and could have lots of institutional investors aren't recognizing the opportunity that they have with generalized solicitation. So they have these giant third-party marketing budgets.
Right.
And third-party marketers are only good maybe for about a year or so, right? And then they start to lose their appeal. And so carving off a part of your third-party marketing budget and creating some regular marketing activities, a website, pitch book, collateral, PR, media relations are definitely, best practices for funds today.
Okay. I know, the Jobs Act it's a huge topic unto itself. So not gonna get into it now, but yeah, somewhere in the future, love to have you come on and we can talk more about that, because I know that there's so much to that.
Yeah. So quickly, what I can say about it is that most people, wealth managers and even hedge fund managers, need to realize it's a bifurcated law. So part of the law really has to do with how to infuse capital into small business, and that's the crowdfunding side.
Right, yeah.
That's one side, and then the other side really allows for generalized solicitation for normally Reg D funds. So, yeah.
And although not much has happened with it at the moment, I think as time goes on and people just become more familiar with it and more comfortable with it, I think you'll probably start to see it'll pick up, that you'll start to see advertising that will occur. But it's kind of like the early adopters, who's going to jump in first.
It should be the emerging managers, because the emerging managers have, especially those with a great story, have an opportunity to be best in class in branding versus marketing or advertising. So, to go back to your word of the day, that's something that people ask me about a lot. What is, should we be advertising? If we're advertising, does it look like we've had a lot of redemptions? Does it look like, people are withdrawing money? Does it look like we're about to close? What does that look like if we're advertising? And, I say to them, you don't see Coke and Pepsi stop advertising because they think they've made enough sales. it's always a continual branding message that you want in front of investors.
That's actually a really good point, because yeah, you look at these large corporations, been around for 50, 100 years, and even though everyone knows them, they still are constantly out there marketing and branding their name, and it just doesn't stop. And I think it's the same thing that the managers have to think about in those terms, that whether they're a small manager or they're an established manager, they need to be out there and constantly trying to figure out different ways of branding themselves. And you've listed several of them. I mean, it could also be something as simple as just speaking at conferences, and just because then you're in front of a large audience at one time, and ideally it's the audience that you want to be in front of. Plus, whenever I speak at panels, I'm on panels, it's almost guaranteed there will be a group of people that come up to me afterwards, want to talk to me, hand me their business cards, and say, hey, let's talk. And so, what better way than to be in front of all those people and be able to do something like that?
Right, and then it becomes something that you can repurpose. I mean, you spoke before about once you've written a paper, once you've written a blog. So let's say you have a speaking opportunity that's coming up. You can tweet that out. You can post it on LinkedIn. You can take your slides and post them on SlideShare once you've completed your talk. You can repurpose and reuse all of those different messages and different platforms to talk about just one panel that you're speaking about.
Yeah, and I do see people that do that, and it's a very smart way of just, like saying repurpose. You just, lack of a better term, recycling, but you're just kind of pushing it out there to a broader and broader audience, because especially on Twitter. I mean, you put something on Twitter, it's seen for 10, 15 minutes, and then it kind of gets buried. So you always have to think about, okay, how else can I phrase this same thing? How else can I put it out there to an audience?
And you can continue to put it out. I tell people all the time, and LinkedIn refreshes, I think, every 3 hours. So just because you've posted something doesn't mean you can't post it and repost it in the same day. Twitter, for example, some people are on it all day, others are on it in the morning, during lunch, or on the train ride home, or at night. So 3 or 4 times a day may not be too much to post the same information.
Yeah, no, that's all part of the market, which is why you actually have to spend time doing this.
I couldn't make up a hedge fund right now, right, and a strategy. So I don't know why a hedge fund manager thinks they can make up their own marketing plan. So.
Yeah, April. Actually, we're starting to run out of time. So, want to thank you for being on the show tonight. Hope you enjoyed it, and love to have you come back. Maybe next time we talk about the Jobs Act, or we can talk about other aspects, maybe something more specific, focused areas.
Sure, I'd be happy to. If anyone listening has specific questions, they can tweet them at me, or suggestions for topics moving forward. That would be great.
And if someone wants to find you on Twitter or through email or website, how do they reach you?
So it's April@therudingroup.com or @therudingroup on Twitter.
Okay.
Pretty easy.
It is. And of course, if anyone wants to get a hold of me, they can find me on Twitter. It's @ShoreCap, or my website, which is shorecapmgmt.com, Shore Capital Management. So this was good. I enjoyed it. And for everyone who tuned in, I want to thank you for joining us today. We hope to see you again. And until next time, remember to skew your diversification. Thank you. Bye.
Bye.